Hi everyone, my name is Adil and today I'll be introducing you to the Monte Carlo, one of the most fascinating techniques to use across various fields like finance, engineering, and even gaming. So what exactly is Monte Carlo method? If I tell you in simple terms, it's basically a computational algorithm that relies on repeated random sampling to obtain numerical results. The method is named after the famous Monte Carlo casino in Monaco, symbolizing the use of randomness and chances, much like the game in a casino. Yes. So now let's take a closer look at how it works. Imagine, for example, we are trying to estimate the value of a complex system, such as predicting stocks, stock prices, modeling climate change, or even calculating the area of an irregular shape. The Monte Carlo method helps us solve these types of problems by running multiple simulations, each with different random inputs to approximate the answer. So let's navigate the process, what exactly happens in the process in a Monte Carlo simulation. First, which is very crucial, we define the problem we want to solve, whether it's estimating future stock values or modeling system reliability. It's very crucial for us to establish the rules and variables of the system we are examining. Next, now we create a mathematical model of the system. This model describes how the system behaves on certain variables, for example, market trends or physical laws. Then we generate random inputs. This is where the Monte Carlo element comes into play. We simulate many possible scenarios by using random variables such as different interest rates, the demand fluctuations, or even environmental conditions. Afterward, we run thousands or even millions of simulations, each based on these random inputs. Each simulation represents one possible outcome of the system under different scenarios that you have stated. Finally, finally, we analyze the results by averaging these outcomes. We can get a reliable approximation of the system's behavior, which helps us in understanding its potential future states or the risks associated with our assumption. The beauty of Monte Carlo method lies in its ability to handle uncertainty and variability, making it ideal for situations where traditional methods might struggle or we might find it challenging. For finance, for instance, it allows us to simulate thousands of market conditions to estimate the future value of investments. In physics, it helps us to study complex phenomena like particle behavior, and in gaming, it helps us assess the risk and rewards in strategy games, for example. And one of the key strengths of the Monte Carlo methods is that its flexibility. We can apply it almost to any problem as long as we can model it mathematically. However, a potential drawback that's need to be mentioned is that it can be computationally expensive and time consuming as it requires many simulations to produce accurate results. In conclusion, the Monte Carlo is a powerful tool that helps us navigate complexity and uncertainty by embracing randomness, whether in any fields, be it finance, science, or gaming. It offers invaluable insights that traditional methods may not be able to provide. So, in order to further illustrate our Monte Carlo simulation, let's dive into our Excel file and look into some examples. So here we are in our Excel file, and today I'm going to demonstrate how to simulate a stock price in the future. We are going to calculate it in the number of days. So in our case today, we have the stock JB Hi-Fi, and we'll try to simulate the stock price of this stock. In order to do so, let's first navigate to our volatility sheet to calculate the annualized volatility. Here I have downloaded the closing price of the stock over the last 12 months and calculated the log returns of the closing prices. You could ask me why log returns. Log returns are helpful to capture the percentage changes in much more accurate and consistent way. And moreover, they are more mathematically accurate for calculations. And this is what have been used to calculate the standard deviation and also the annualized volatility. Annualized volatility is what we are looking for as it is very crucial for us for our calculation. So moving to the first page, here in cell B2, I have already predetermined a pre-reference cell, so it has fetched the value and this gives us the result of 22.53%. But that's an annual volatility rate, and we are simulating the future prices in days. So we need the daily volatility rate. In order to calculate that, we simply take the annual volatility rate and divide that number with the square root of the total number of trading days. So if we do that, here, divide it with the square root, function of Excel. In Australia, there are 252 number of trading days, which is standard. So let me check in the 252 here and hit enter. So the daily volatility rate is 1.42%. The daily volatility here is the expected price change. This means that the price can go up and down, and we can expect it to be plus or minus 1.4%, 42% in a day. After we are done with that, moving on here, we'll try to simulate the price. We can use the current price and use a random number generated in Excel to simulate the price. So at first, we're going to simulate it from a month from now. So there are 21 number of trading days in a month. So the process here is we take the starting price and multiply it with by the expected change in a day. Here, I'm going to use Excel's norm inverse function to and to get our simulated price. In probability argument, we're going to use random generated number, and in mean we are going to use a change base. In mean argument, we are going to use a change based on the expected price change, which is actually zero in our case, according to the random walk theory. And in standard deviation argument, we're going to use our daily volatility rate here and closing the parenthesis and hit enter. So here we got the price of our day one. So this is only one possible outcome. Obviously, if the volatility changes, this will also change. And moreover, this is a random number generator. This is not the price that's going to look like, but it's one of the possible outcome in day one. So if we want to see a bunch of possible prices, in Mac OS, we can hold the command button and press the plus key to get a new random number generated. So we can see the price changing here. For day two, or the following number of days, we're going to copy down the formula and make some changes. So that, but before I do, our standard deviation is fixed. We're not going to change it, so we're going to absolute reference it and copy down the formula and make some changes. The change here is that we don't want the starting price now. We want the value in G9, the value in day one, and we get the value here. So for the following number of days, we're just going to click on here, and the Excel is going to do the magic on its own. So these are the values of the 21 number of trading days in a month. Here's one possible outcome that we could see in the following days. And on the left-hand side here, I have set a price chart ahead of time so we can see the changes in prices of different possible outcomes. Just for instance, we're going to hold the command button and press on the plus key to see the changes. We can see the graph is reflecting the changes on different outcomes. Okay, now the question is that how is that one simulated return is useful? Well, I agree on that one simulated return isn't that useful. But if we do this many times, for example, 500 or 1000 times and record all the outcomes, then we can start to develop a range within which we can expect the price to fall. This is what our goal we are trying to do in this demonstration. So over here, I'm going to collect the outcomes of 21st day and calculate the statistics over here to develop the price range. We're going to use Excel data table function. The data table function helps us analyze on how changing one or two variable affects the outcome of a formula. It is widely used in financial modeling to compare results across multiple inputs. So we are going to use this function to give us 1,000 outcomes of the 21st day variable. So we take in the variable here and select our range, 1,000 days. Then we click on data, what if analysis, data table. And since our values are in column input cell, we're going to click on column input cell and randomly select a cell anywhere and click on OK. There we go. So each of the rows of the cells are now simulated outcomes of the 21st day. Now, moving into here, we're going to calculate the statistics. The first is the mean price. So we're going to select the average function of Excel and chuck in the values of our data set. Close the parentheses and hit enter. So a min price is $79.94. And here the median function, which is the 50th percentile of the data set. We're going to select the price, our range again, and hit enter. We'll also calculate the standard deviation. You can use the standard deviation.s function, select the range again, and hit enter. So the standard deviation is $5.27, which means that each variable deviates with $5.27. I have already predetermined max and min function. So in our data set, the maximum value is $97.41 and the minimum value is 65.16. So what if we want to see the possible, what if we change our possible outcomes? So we're going to hold command and the plus key again to see the differences. Now moving down to the percentile section, we're going to use Excel's percentile function, percentile.exe, select our array here. Then in key argument, we're going to select this value here, closing the bracket, and we're going to get the 5th percentile. So this means that that 5% of the predicted prices are below 71.18 cents. So so only a few prices, the lowest ones fall below this number. We're going to do this for the next ones, but it's time consuming. So I'm just going to absolute references because our array is not changing. And I'm going to drag this down and Excel will do this for us. So here we have a list of percentiles ranging from 95, 25, and 75. So the 75% shows that 75% of the predicted prices are below 83.52. So only the higher 25% of prices are above this amount, meaning this is towards the higher trend. So that's it wrap up. And this gets to tell us that how using Monte Carlo simulation, we use to model JV Hi-Fi stock prices. As we have seen, this method is particularly helpful for developing a range of possible prices outcomes based on the historical volatility and returns. By simulating 1,000 of potential scenarios, we are able to generate a price range that help us to understand the possible future movements of the stock. So we have seen that the Monte Carlo simulation allows us to calculate a range of simulated stock prices by randomly sampling from a distribution of past returns and volatility. This technique does not just provide a single forecast, it helps us to explore a wide variety of potential future outcomes. By generating these different scenarios, we can better understand how the stock price might look like and behave under different varying market conditions. So as we have seen in our case that we have been able to use historical data to model a range of possible future prices, this gives us a comprehensive view of the stock potential movement over time, helping us to assess both the risks and opportunities associated with investing in the company. Monte Carlo simulation is particularly useful for risk analysis as it provides a probabilistic framework for decision making. As mentioned in the introduction, it enables us to visualize potential outcomes, allowing investors to prepare for different scenarios, whether they're optimistic or even conservative. This approach is very essential or could be very helpful for making informed, data-driven decision in finance, where uncertainty plays a major role. Overall, Monte Carlo gives us the ability to model a wide range of outcomes, providing clarity on the future potential performance of a stock. It is a valuable tool in finance and it's widely used in the industry. And that's a wrap up. Thank you for watching this analysis. I hope this demonstration has helped clarify the application of Monte Carlo simulations. Once again, I appreciate your time and thank you.